Okay, well, first up, let's invite Devina Mehra, who's joining us, founder, chairperson, and MD of First Global. Devina, good afternoon. Before I take the first question, let's just pull out an interesting tweet that Devina tweeted a while back that Russia perhaps was preparing for sanctions and was always this was something which was always in Russia's mind because their investments in U.S. treasuries is zero. They moved money from US and euro to gold and renminbi, the China that is, and moved away holdings in western areas which can be frozen. So, Devina, good afternoon. So, in a sense, is this something that market should have been prepared for and should in some sense be an eventuality that has now happened and the market should now price it in? I mean, what's your view then?
Yeah, hi Anuj. Yes, I mean, Putin clearly, planned it. So I think his bet, and which I would tend to agree with, I'm not geopolitical expert, but I would tend to agree with this, that he's betting that what the so-called international community will do at best is financial sanctions. So he has prepared himself for that. He probably doesn't care that on the short-term hit on the ruble or, for that matter, on the Russian stocks, etc. And he's betting that it won't go further than that. I think he would have taken the bet after what happened in Russia or in Afghanistan, that US or the other nations did not really care what went on internally in that country, and this was a country where they already had a presence. So I think he took a bet that they would not intervene militarily in Ukraine, and the other side was that Ukraine would become part of NATO, and so therefore, he would have the NATO allies at his doorstep. So he's taken that bet. Now, as far as markets are concerned, what best you can do is go back in history. And if you go back in history, if you let us say, look at the Gulf War I, so Iraq had this entire build-up at the Kuwait border, and the markets fell very steeply during that time, the international markets. But when the invasion actually happened, most of the fall had already happened. So the fall did not happen post the invasion. Most of it happened before the invasion. And once US and the other, UN intervened, the markets actually went up. So that is one. We were also looking at longer term data going back 40 years of everything from, 9/11 back to when US bombed Libya and so on from 80s onwards. And what we have found is there is little lasting damage on markets which are not directly involved in the conflict. So if you look at the Sensex, for instance, or it normally, if you look at that 1 day, 1 week, you'll see the impact. By the time you are at 3 months, that impact is totally gone in almost each of the scenarios. And we've looked at, since then, maybe about 20 cases. We're just doing a little more work on that. So what as investor you have to look is the markets which are directly impacted by this conflict, markets as in any kind of commodities or anything. For example, if you look at, a little while I was looking at among the large caps, the only green was Hindalco because aluminum has got a boost. If you look at the commodity markets, wherever Russia and Ukraine are big players, whether it is oil, whether it's gas, aluminum, potash, palladium, nickel, the agri commodities, year to date, they are all up between 20 to 30%. Palladium, I think, more than 30%. So those, for any company for which, for example, agri commodities are an input or oil-related things are an input, it will have an impact. If you look at Europe, that is directly impacted because a lot of the energy needs of Europe come from Russia and the neighboring countries. So you will have to look at the direct impact. As far as the overall impact is concerned, as I said, I am no expert, but if it doesn't escalate into anything resembling a world war, the impact is usually limited on markets other than where the conflict is directly going on.
That's a nice summarization of how you're thinking about this whole thing. Devina, thanks for joining in. Afternoon, Prashant here. Two questions. One is, I also looked at all that, the past conflicts going back 30, 40 years. Yes, you're absolutely right that 3 months, 6 months out, it's barely visible. But the point is, do the starting points matter? in terms of market levels and more importantly valuations, to make that conclusion that this is it turns out to be a good buying opportunity in that sense. And second, for viewers who are watching, Devina, I mean, and those, as I began by starting the show, those who created cash or have investable surplus, what kind of time horizon should they have now when they're looking at buying even today or at these levels?
Okay, two things. One thing which I missed out on the first thing, which is that you are also seeing some safe haven flows, so which is why gold is ticked up. And if you look at what we have done in our portfolios, yes, we've bought some gold. As far as India is concerned, we had slightly higher than normal cash levels. But what we normally do in our portfolios is that since you're only playing probabilities, if there is a reasonable probability that markets will go up, but there is some risk, we buy hedges. So we have been about 80-90% hedged on our equity portfolio. So that, and which doesn't help you if the market falls 5%, 7%, but it is a hedge against a catastrophic fall. So that's been our strategy. And as far as advice for whether to put in money, okay, first let me talk about whether the starting levels matter, and they do matter, and which is why if you look at the US continues to look weak, and this is only one of the inputs because you have inflation, you have the Fed, and so on, and you've had very good years for the US in the last 2-3 years, and so therefore there is a reasonable case for being a little cautious. India, on the other hand, has not had such a great run if you really look at it beyond. Last year, NSE 500 was up 51%. We were up 56%. If you look at 2020, while we were up a great deal from the COVID lows for the entire year, the indices were up only 14-15%, which is nothing very extraordinary. And if you go back another 10 years, you compounded less than the fixed deposit rate. So you compounded at 8.5% from 2010 to 2020. So you had like about 1.5 years of very good markets. So it's not as if you're very far above the trend line. In fact, you're far below the trend line. So therefore, if you choose carefully, number one, as I said, you have to be cognizant that there will be markets which would be directly impacted, where input-output prices will be directly impacted. So if you account for that, if anyone asks me for advice just now, I would say that it is time to start getting back into the markets. Maybe, not put 100% of what you want to put today, but, split it between the next maybe 2-3 months. I think that would be a reasonable strategy, but very selectively in terms of sectors, in terms of stocks, because India does have the geopolitical risk may not be the major risk for India, but India does have other macro risks, and oil will push inflation. I think currency is a real risk. So that is something you have to pay attention to. And when I talk of input prices directly, it shows up in margin compression. And last quarter also, you've seen margin compression in a whole range of industries, from FMCG to certain pockets of chemicals, to even capital goods, where you are selling at a fixed price. So you'll have to do more sector and company level work rather than just buy overall indices.
Okay, all right. Afternoon, Devina. Good to speak to you again. You said that you'll have hedged most of your portfolio. Give us a sense, have you been raising some cash levels? If yes, what is the cash levels you're sitting at? And also you said that, that it's time to start dipping in now. Which is the top sector that you...
I did. Yeah, I did say that we have higher than normal cash levels just now in our India portfolios. But, we do that to an extent, but not to a very large extent, because you could have made a case even middle of last year, a little beyond that markets were already too high and you should sit on the sidelines. So we think a better strategy usually is to choose carefully and ride the market, but have a hedge against a catastrophic fall. Especially, in this kind of thing, you can make all the guesses you want, but who knows ultimately what the world leaders would do. So as I said, I am no expert other than having spent a fortnight in Ukraine 15 years ago. I can't claim any great knowledge of what exactly is happening. So
Okay, I don't even have that, Devina. So at least take that. But Devina, just stay on. There's an important story which is breaking. I want you to react to that as well. But first, let's go across to Timsy. Now, this is important because we know that oil marketing companies are sitting on some losses now because they can't raise prices. Elections are going on. So what happens on 10th March? Will prices go up by how much, or will excise have to be cut again? Timsy is breaking some important stories, so let's ask her. Timsy, what have you picked up?
Well, currently the top government is actually watching the entire geopolitical situation and especially the impact on global crude oil prices very closely. What we are told by sources is that the PMO, FinMin and Oil Ministry recently had detailed discussions on the current global oil prices. What is an analysis that has been given in that meeting is that oil marketing companies are currently absorbing around rupees 10 rupees per liter on petrol and diesel per day as a loss. So they are absorbing that loss right now. Petroleum Ministry has informed PMO and FinMin about these losses being faced by these OMCs. And post that analysis, PMO has asked Finance Ministry to reassess the current excise levels. So now Finance Ministry is doing an internal analysis post this meeting as to how much excise hit can be absorbed if at all government decides to do so. The situation is very volatile. As you rightly said, politically the situation is very close because of the state elections that are ongoing. So any decision on whether an excise cut has to be given or any hike in MRP of petrol and diesel has to be put out is something that the highest political level will take a call on, and no decision has been taken as yet. Right now, internal analysis is happening at the top government corridors between all the key stakeholders, including Petroleum Ministry, OMCs, Revenue Department, CBIC for that matter, who's the custodian of levying these excise duties, and not to forget, PMO taking charge of the entire situation right now.
Okay, TMC, thanks a lot for that. Now, Devina, for us, crude oil prices have been the biggest. I remember in 2006 or 7, it was when we had that massive correction when oil went to 140. When oil goes down, it's a win-win, right? You can cut some prices, increase a lot of excise, which is what we did. But when things reverse, then you are in a conundrum right now. Whichever way you do, you cut excise, you're hurting macro. You don't cut excise, you're raising inflation, and of course, it's politically very sensitive. So, your thoughts on this story?
Yeah, I mean, see, this is a political decision, so very hard to say what will be done. But as I said, for India, there are macro risks. And when I spoke of currency, it's precisely because you have high inflation, but you're continuing with a relatively loose fiscal policy and a relatively loose monetary policy. You've decided not to raise interest rates, even though most emerging markets have raised interest rates, and not just once, 4, 5, 6 times also. And now, of course, the Fed is also almost certainly going to raise interest rates, but you have chosen to sit it out. So, in macro, that is the thing, that something has to give way. We want all the good things in life. We want high GDP growth. We want low unemployment. We want low interest rates. But it doesn't all happen in a strong currency. So I think this time the give might be the currency. So that is again something to be kept in mind, which is why I said, sectorally you have to be careful in today's market, because the risk may not be directly the Russia-Ukraine conflict, but you do have risks in the market, macro risks in the market.
Well, Devina, before we let you go, since we briefly touched upon, politics, in the next 2 weeks, everyone's hoping that the Russia-Ukraine situation cools down. But, what is the market factoring in terms of the state elections? What if the ruling government doesn't come out trumps, or what if they do come out trumps? Do you think we'll get a favorable reaction if they do, come out victorious in most states?
I don't think, that this, as you say, something can be an excuse for something going up or down, but I don't think the state elections per se will have a very lasting impact on the market. It is like when a government comes in or out, or on a budget day, you get an impact. But is that what is actually determining the future direction of the market? for a reasonable length of time? I don't think so. I mean, a lot of it is noise which gets factored out, and the market goes in whichever direction it was anyway going to go to. So that would be my take. I am not too fussed about the state election results.
Got it. Devina, just very quickly, the market had other problem before this Russia situation started, right? US Fed, the March meeting coming up now. They say that nothing is ever fully priced in till the event. Would you agree with that? How should one approach the rate hikes?
I don't think that is always true, that nothing is fully priced in. I mean, there could be a case that you're pricing in too many rate hikes and not all of them will fructify, or that at certain stage the Fed will need to backtrack. So, but as I said, everything becomes then an excuse for the market to go in the direction in which it needs to. When the US in general looks a little weak, and primarily because it has had a very good run for many, many years. But India is in a slightly different basket. So, and in general, we think the baton is passing from the developed world, barring some exceptions, we like Canada, for instance. But also, China in some ways is also, strangely enough, acting as a safe haven, because as we saw that Russia also moved a lot of money to the Chinese currency and all that. So you see if the Chinese bonds are also acting, it's somewhat like a safe haven. So we are looking for a change towards the emerging markets. And in general, this year, we think India is likely to be an outperforming market, which it hasn't been for a long time, barring 2021. So 2021, it was, I think, the number 6 market. But before that, for years and years, it was like number 19, 21, 24, that kind of range. So it was very, very middling market for many, many years. So we're just coming to that outperforming stage, and I hope we manage to continue. I mean, as of now, that seems to be the highest probability outcome, but in markets, you're still talking only probabilities.
Okay, thanks so much, Devina, for joining in. Let's hope the Indian markets get back to its winning ways and outperforming as we did in 2021. It's been good chatting with you. Well,
thank you.
For the markets on the whole, we have seen another leg down. So now we are moving closer to around that 16,400 mark. The December low was 16,410. For the time being, though, let's listen to the former RBI governor who shared his views on the Fed's policy stance, emphasizing the need to balance out the risk of over-tightening rates. Listen in.
If inflation in industrial countries had been low, if inflation in the US was low, the Fed would have a clear sort of sense of what to do. And that would be, don't tighten into a supply shock. Allow the supply shock to play out and even perhaps increase accommodation. With inflation where it is, that becomes harder. I think the Fed will have to perhaps balance out the risks of over-tightening. So my sense is what this does is take some of the more outlandish sort of moves off the table. Fed will start the process of tightening in its March meeting, but maybe it will signal a steady pace rather than an abrupt pace.